Welcome back to another episode of Beyond the Mortgage. I'm your host, Tracy Valko, and I'm excited to be here today. I have an incredible guest, Tania Bourassa-Ochoa. She is Deputy Chief Economist with Canadian Mortgage and Housing Insurance. In today's conversation, I'm going to be diving into what's really happening in the Canadian housing market. What's the driving force right now for affordability in Canada, and what are the challenges? We're going to be talking about housing policies, interest rates, and what's leading up next in Canada in the housing market for 2026 and beyond. I've been waiting a long time to have you on because I know we've got a lot of information to talk about. So thank you so much for joining me today.
Thank you for having me. It's really a pleasure to be here today.
Now, I've got a lot of young listeners and a lot of young women that are always inspired by some great women like yourself, leaders that come on the podcast and talk about their journey. And before we get into the economy and the housing supply and interest rates, I really want to dive into how it actually came to you to be an economist and what was that journey for you?
Yeah, well, actually, I think like a lot of maybe young people, I think I was a little bit confused as to what I wanted to be when I grew up. And so when I started my CEGEP, so I'm from Montreal, I live in Montreal, so we have the 2 years of CEGEP before going into college. I took my first macroeconomic class, and I honestly fell in love with that course because I was, well, good in maths. I was really interested in politics, international politics, policies. And I also found that the economics world was also very much looking at the individual, at decisions that people would take, and so there was this aspect of psychology as well, which I was really attracted to. And so I discovered this world where it would merge math and policies and diving into the human mind as well in terms of decision making. And so that's what attracted me into economics. And,
yeah.
A few years later, here I am, and honestly enjoying and loving every bit of it.
Amazing. And you're so inspiring. I've watched you numerous times on podcasts, your information that you provide. I mean, it helps all of us in the industry. I'm in the finance industry, as most listeners here know, but also just for Canadians as well to understand what's going on in the market. It's a very complex time. And to have individuals like yourself, it's very inspiring. It helps really break it down. And to be honest, make it very simple too in the aspect of for people to understand it, because a lot of people aren't economists and they get overwhelmed and overstimulated by a lot of the information. I do really value a lot of the information that you post. Thank you for sharing. And let's really get into a lot of really what this is about is really breaking down what's going on, which is a very complex time in the housing market. It's ever changing. And one of the biggest topics this year, and one that you talked about in one of your recent reports in February, was about the massive renewal wave. Something that economists have been warning about for years is this massive renewal wave that was coming in 2026. And from your vantage point, what do you actually see that's happening across Canadian households right now when it comes to renewals and the reset of these higher interest rate environments?
Yes, and so you said it. I think we were also part of those sounding the alarm bells a few years back because the wave was looming upon us, and it was scary. It was scary because we were calculating and we knew that a significant number of Canadians had gotten into the market, bought homes at peak housing prices and at floor low interest rates. And now we were seeing a very, very large number, close to 2 million Canadians having to renew. And so that difference in interest rate was quite significant. We already knew that Canadians were not necessarily struggling financially, but that it was already being a little bit more financially challenging due to the high cost of life, due to many other elements. We were seeing savings coming down. And so that big increase in monthly mortgage payments was worrying, not to say the less. Fast forward a few years, we're in the middle of this mortgage renewal wave. And what we're actually seeing is that, yes, there's more Canadians that are struggling with their monthly mortgage payments. We're seeing arrears coming up, but it's still much lower than what we had expected. And so there's a few reasons for that. Number one, Canadians have shown to be extremely resilient. And so I talk about this playing that financial Tetris very well and being able to cut where we need to cut and making the budget work, making the ends meet at the end of the month. But for a lot of Canadians, and the large majority of them that renewed, they chose to opt for a longer amortization period. And so what that did is basically making the monthly mortgage payment a little bit smaller in the short term. However, there's a trade-off, right? You're still paying your mortgage for a longer period of time, and in the end, you're paying higher interest rates. But in the short time, it did alleviate some pressure. And so it did help a lot of Canadians kind of surf that wave, if I could put it that way. That being said, there's some regions that are struggling maybe a little bit more than others. And so there's a lot of other elements that come into play there.
Do you think too, and because I'm in this a lot right now, especially renewals, and we're on the mortgage side and dealing with a lot of clients, especially over, like, I've been in this industry for almost 3 decades now. It's hard to believe it just went like that. But this cycle is very different because, to your point, like 5 years ago, when we were helping people either buy a house or they were in a renewal, we were in these low bottom interest rates of like 1.5%. And
Yes.
in that time, now we're coming into, that cycle, that 5-year term, which is the majority of where I think, and I think a lot of your reports talk about that, is that the majority of where clients or that your homeowners take is a 5-year fixed rate term. It's a conservative, and it's where we've been historically. So they're coming up now for the renewal, and they're coming into like 4% interest rates, which is substantially higher. It can increase their payment on average over $700. And values haven't indexed to inflation in the sense of we had this uptick, then we had this decrease. And especially because I'm in the Ontario market, seeing the impact of that, where values were 5 years ago is pretty much where they're at now. And people don't have the equity to take out, right? So just wanted you to speak a little bit about that, because are you seeing that trend of where I'm seeing is that people, in some cases, if they've got too much debt, have to sell, not want to sell, and maybe restart again, right? With putting 5% down again.
Absolutely. And just to come back to your point where we were talking about interest rates have come down since, a few years. And so there is that. But despite the fact that these interest rates have come down for consumers that have to renew, that still means an increase in interest rate, right? And so that's very important to keep in mind. And then you're right. So the context is that for, when you look at Canadians overall, the levels of debt are very, very high, especially when you compare to other countries around the world. In some regions, like it's the case in Ontario or in BC, so specifically like the GTA or Vancouver, these are high-priced markets, right, when you compare it to the rest of Canada. And so borrowers there are a lot more leveraged, have a lot more debt. And so that weighs a lot more, especially when you're talking about renewal, because even if you're opting for these longer amortization periods, and it is having a impact on your monthly mortgage payments, you're still paying more than you were before, right? So that is important to note. And unfortunately, that is squeezing a lot of families. It's squeezing a lot of small investors as well. And so in the unfortunate situation where a borrower does not necessarily want to sell, is facing that only last option to sell their property. The housing market right now is not helping the situation, exactly. Right? Because markets are not liquid, if I could put it that way. The market is on the buyer's side and not on the seller's side. Prices have come down in a lot of regions. It takes a lot longer to sell your property as well. And so if you're in this situation where you are having to sell your property, well, it's not very easy to sell it at the price that you want, nor in the time that you want to sell it. And so that is one of the reasons why in regions like the GTA or Vancouver, we're seeing arrears increasing at a much faster speed.
Yeah. So, in talking about that, in your article, you talk about these two financial realities, right? One showing resilience and then one showing financial strain. And a lot of that has to do, to your point, in the GTA. We're seeing that. Probably, I think that our actual region's impacted more than even Vancouver, I think. Like Vancouver.
Absolutely. Yes.
Vancouver's more equity rich over the years, so I think that's helped them sustain it a little bit longer or weathered that buffer a bit with values coming down where we just don't have the margins here in GTA. And your data shows that. Like I can see it on, which is amazing on what you provide on your articles. But I think the bigger thing is, where do you see the relief on this? Like I know no one has a crystal ball and it's hard as an economist to predict. And it's just people would just like to know. And I mean, a lot of us, do you see relief in this in sight, or do you think this is going to be a longer pain right now for the next few years?
So that's the crystal ball. It's not easy. There's definitely some signs. We expect on. So first, if I could go back and just say another very important element to keep in mind is the stress test. That was implemented a few years back. It was a tough mortgage regulation change because it did prevent a lot of people from entering the market and was squeezing and making it harder for people to qualify. That being said, it is what is helping that interest rate increase that we had kind of projected to be a little bit lower and less steep than we could have anticipated. And so for the Toronto case or for the Ontario case, in terms of what we're expecting, we are expecting to see mortgage arrears continue to increase. But it is important to note that we're increasing from historical lows. So it's very important to keep that in mind when you look at, recent history in the last 30 years. We're still below that those peaks that we've seen. If we compare to the 90s, for example, we had a very different context. Economically speaking, the economy was a lot less diversified. When you look at the mortgage regulation that we just spoke about, it was not nearly the case present back then. And so there are many elements that are helping us or signaling that things will not be as bad as what we've seen in the 90s. That being said, when you think about the ability of mortgage consumers to make their payments, it's all about jobs. It's all about jobs. It's if you have income that is coming in, you're going to make things, people are creative. We're going to make the math work and we're going to be able to typically make their monthly mortgage payment. The risk is if people start losing their jobs. And in tariff exposed municipalities, and that is the case in many regions in Ontario, we've seen hiring stopping, but in some places there's been a lot of massive job losses. That is where the risk lies. I think if there were to be or continue to be this shock in certain markets in terms of people losing their jobs, that's where I think things could get a little bit worse. So we do see mortgage arrears continue to increase in a context where things don't get necessarily worse. We think that it will, we'll be able to kind of get over that wave. But if we were to see more severe job losses, that's where things would hurt a little bit more. Not to say that it's not hurting for a lot of people right now. I want to be clear on that. And another thing that for me I think is worrying is when we're looking at some statistics from Statistics Canada from a financial asset survey, when we look at what people have saved up, right? And their ability to say, okay, if I lose my job, how much savings do I have? Or how many liquid assets, money that I could have, readily have access to in order to make my monthly mortgage payments? It's actually worrying because more than 40% of mortgage consumers in Canada don't have sufficient savings or liquid assets to cover 1 month of monthly mortgage payments. So there is that
that's incredible, eh?
That aspect that is worrisome. And so like we were speaking about, if that's the case and you have to turn to the housing market and sell the property, then it becomes more difficult in that sense.
Yeah. I think there's so many challenges right now in the market when it comes to that aspect, and consumers and homeowners just having financial struggles right now, whether it's jobs been impacted, inflation over the last few years has escalated. And it's not just inflation on one aspect of one item, it's everything. It's like, I mean, food prices are just astronomical. And I think it would be very difficult for a family of four. And if you get laid off, like you said, and you don't have the savings, like I didn't actually realize that stat that you said. So that just, and it does make sense because a lot of the homeowners we see in family, what I saw people have in terms of assets and liquidity 5 years ago to where it is now, it's pretty much non-existent. And that is even with the most savviest of, I would say, financial homeowners. Something has impacted them where they've had to draw into that account, and now they don't have that savings there. So that's challenging. And I think the job market, for what you said, for sure, we're seeing clients that are having challenges in this market because of, a lot of places in Ontario were impacted in more tariff driven economies, right? And
Yes.
yeah, and I think that's challenging. And then it's interesting because I look at this and all the challenges we have today, it's going to affect where these homes are being built in the future. If people can't afford it now and are having struggle, how are they going to save for that down payment of that house down the road? And we're not building like we used to, right? So, I'm an optimistic person at heart. And I think that there is a great segment of people, first-time home buyers this year, and maybe you can talk a little bit about that there are people on the sidelines that have had great jobs and have been able to stay in them and have saved money and have been sitting on the sidelines waiting for these rates to come down. And we've got we've got a larger pool of first-time home buyers now that are starting to think about getting back into the marketplace. And maybe you could talk a little bit about that with your stats and research that you've done.
Absolutely. I think that is a very, very interesting question. And just to circle back, you were talking about the high cost of living and the difficulty for a lot of first-time home buyers to get into the market. So all of this is, and even circling back to when we were talking about not having the savings or liquid assets, this is all resulting of this affordability crisis that we're I know it looks different now than it looked a few years ago, but we're still in it, and markets are still unaffordable for many, for the majority. And so, yes, this idea of pent-up demand that is kind of waiting on the sidelines and waiting for conditions to be better, for interest rates as well. There's interesting surveys out there that talk about the expectations of first-time home buyers and the reality, right? So even for those who, like you said, have good jobs, they've been able to save, but now are looking at what they could afford. It's not really looking at what they were necessarily expecting in terms of housing, in terms of location as well. That looks very different in reality than maybe what many would have expected. And so as a result, we're seeing, and I would say that, but also the very uncertain economic context, that affordability aspect, there's a lot less households that are being formed. So yes, obviously immigration is playing a huge role into that. But even for those who would normally be forming households, they're not. And so there's a really interesting, when you look at census data and you look at the share of young people between the age of 20 and 30 that are still living with their parents, that number actually surprised me a lot. So in Toronto, it's close to 1 out of 2 young people that still live with their parents. When you look at Canada as a whole, it's somewhere around 35. But when you add young people that are living with others than their siblings, so that could mean roommates as well. So they're with their roommates, they would like to move out, but they're still not forming their own household. That number has increased significantly over the last decade. And so that pent-up demand, like you mentioned, or that we also like to call it the suppressed household. So they're kind of waiting before they actually make their household and enter the first-time home buyer market. It is, in our view, very much present. So you would remember that, a year in end of 2024, there's been changes to mortgage insurance as well. So there's longer, the big we, allowed for longer amortization periods in the insured space, and the cap for mortgage insurance went from 1 million to 1.5. So in markets, high priced markets like Toronto and Vancouver, that's where we saw a little bit more of pickup in that. But all of that to say that we did see, if we look at like our mortgage insurance numbers at CMHC, but even across the industry, there's been quite a significant pickup in mortgage insurance activity. So there's been more first-time home buyers that have been entering the market. But what we find is that that change in regulation didn't allow so much more people to qualify. Yes, it did, but not as significantly as you would think. Rather, those who were already able to qualify bought more home. And so that's a very interesting thing, because buying more home could mean buying a home that is maybe more suitable to their needs, right? And so to that expectation that we were talking about, maybe it means a home that is closer to the workplace. And so, that trade-off between the commuting to work. And so it's interesting because, yes, we are seeing a little bit of that. Those first-time home buyers entering the market, these policy changes that are helping some to qualify, but also to have access to that more suitable, I say suitable, but that kind of meets their changing housing needs.
So just on that point, because you got me thinking, what I'm seeing a shift this year, and I'd love to hear your thoughts on this. The difference from last year, this year for first-time home buyers, first of all, is I do think there's more entering into the first-time home buying space and not sitting on the sidelines. But the biggest thing is I'm not seeing that they have to have co-signers this year as much. And remember, I'm in the Ontario market, which has been hit the most on values, but it's actually worked to the benefit of first-time home buyer because they've waited on the sideline, they save more money, but they can afford that house that they couldn't afford last year or the year before because that value was as higher. Because we've seen in some markets, I'm specifically in Kitchener-Waterloo, but again, we service, everywhere in Ontario, but here I've seen even values in the last 6 months decrease 8 to 10%, just depending on the type of home. Right? So these people, first-time homebuyers, are getting in, and we don't need them to have a co-signer. What's your thought on that? Have you seen that trend in certain areas where they don't need that as much that they used to? They used to have the mom and dad co-sign.
So we don't really have readily stats on that per se, but it is definitely something that we're hearing from the industry, kind of that shift. And it is also evident or when we're seeing like more of these first-time home buyers entering the market, when we're seeing, like we mentioned, having access or being able to get more, to qualify for more basically. And so that is a very interesting shift. With prices having come down, that is definitely an element that is important to note. For affordability, I mean, when you look, and so we recently released an article on affordability index across the CMAs in Canada. So obviously affordability we've saw in Ontario and in, Vancouver and BC. Markets were already unaffordable a long time before COVID hit. But when you look at the other regions across Canada, it's really as of 2019, post-pandemic, during the pandemic, that's when that affordability deteriorated significantly. More recently, in regions where we're seeing these price decreases, incomes have been able to continue to grow, and so that has allowed affordability to improve slightly in some markets. And so that is definitely, it is something positive. I think we're moving into the right direction when we're thinking about affordability challenges for Canadians. That being said, there's the supply story, and that's what is also worrying us. When you look at the condo market, when we're looking at, okay, yes, prices are coming down. Yes, that is actually maybe a good news for a first-time home buyer that is wanting to enter the market. But developers are, taking their foot off the pedals. A lot of projects are being canceled or are being, I would say postponed, but a lot of them are truly being canceled, in some cases being converted. And so that is worrisome, because what that means is that when you look a few years in front of you and you see, there's a risk that we face a housing supply shortage in the medium term. And so there's that risk that if demand and all of that pent-up demand that we were talking about, because if all of a sudden that demand gets ready and comes out in the market and is ready to buy, but all of a sudden we have this supply shortage, there is a risk of seeing these prices accelerate all over again, to seeing like affordability deteriorate all over again. So that's definitely something that is worrying, is to see that slowdown in construction activity that could have an impact again on affordability.
So I think this is an interesting topic. Let's talk about the condo market, because I feel that has impacted values specifically here in the GTA. I think it's brought down the median value overall, because we've seen the decline of values in condos exponentially, especially the pre-construction ones that were bought from 5 years ago. I'm not even going to say let's just say even 4 years ago, right? Like in 2022, 2022, right? A lot of these people that now are coming into where they're supposed to be registering the mortgage, not just occupancy, so registering, meaning that they have to have a mortgage in place on these condo units, and values are coming in some cases, and I'm seeing this, 50% less than what they bought. What can you talk about that, statistics on that, or maybe just talk to me about how is CMHC handling these situations where we've seen clients, and then from the builder side as well?
Yeah, absolutely. So definitely when you look at the condo story, Toronto and Vancouver, but to a lesser extent Vancouver, is definitely been in this turmoil in the last couple of years. The more, if we look at recent numbers, a lot, like you mentioned, like pre-sales have dried up, stock or units are piling up. The inventory is definitely piling up. Toronto and Vancouver are two markets that have been for many, many years magnets of attraction for investors and for immigration. And so with immigration having come down significantly, that has also had an impact on the ability of these investors to rent out their units. When you look at carrying costs, so if you were looking at a small condo investor, for example, and you look at the carrying costs, they've increased quite rapidly and significantly over the last years. So think about your mortgage payments, think about your condo fees, your property taxes, your insurance. All of these carrying costs have increased quite significantly. And when it's hard to also find a tenant, there's a lot of supply out there, there's a lot of competition out there, rents are coming down. And so there's a lot of small investors that are in a negative cash flow position, and that are also trying to some that are not able to make it financially speaking, and that are also turning to sell their unit on the market. So that is adding to that supply when you look at those pre-sale condos, but also existing condos, both new and existing condos are adding to that supply. That is definitely, and we talked about that earlier, it is influencing the arrears market like we talked earlier. So there's definitely a link there. Another element when we think of the condo market, a lot of first-time home buyers a few years back entered the market into the condo. So they bought their condo, they're in their condo. A lot of a big part of the market drivers is the millennial generation. And that millennial generation is at the stage where they're thinking about, growing their families and, maybe moving out of their condo to buy a larger condo or a larger home. And they're kind of also stuck. So that condo story and that these very, very relaxed market conditions in the condo segment is also impacting that housing life journey, if you will, for a lot of that younger or that generation of millennials as well. So so it is impacting, like I mentioned, definitely developers. A lot of them had paused projects, canceled projects. When you look at the number of canceled projects in the region, there are definitely a lot more of them that there were before. Some of them are trying to convert to purpose-built rentals. So rental buildings. It's easier said than done. It's harder if you're very advanced in the planning stages, but at the earlier stages, some were actually able to convert. But that is, like I mentioned, a lot of them are really pulling back in terms of construction activity. We're seeing housing starts in the condo segment dropping significantly. We're expecting that to be the case for the next couple of years. And that's a little bit where I was coming from when I was saying, well, it is maybe supporting that affordability in the short term, but there is a risk in the medium term for if demand picks up.
So much to unpack, right? So complex. Like the condo
Yes.
market is, and yeah, it's just so complex. So let's talk about purpose-built rentals, because we know that that's been something that has been on fire in a positive way for
Yes.
a lot of builders out there, to be able to maximize on that. But are you seeing now with your research that that's kind of hitting a peak as well, that we're not seeing as many purpose-built rentals, or is it capped at this point? I'm starting to see a bit of this trend where we're not seeing as many being built. And I don't know if it's because of municipality and legislation on like getting approvals on permits, and then the water supply. Like there's a lot of critical programs that are needed to be able to build these massive big units that has to come
Yes.
from the city. And we're seeing challenges, especially here in Kitchener-Waterloo. We've got a water supply challenge right now here, which I think is limiting a lot of building developments. Is this something that you see trending across the country in different aspects, or do you see that as being more of a growing segment than you do on the owner-occupied?
So it's very interesting when we're talking about growing segment or not, because one of the things that we have to understand is when we're talking about housing starts, whatever the housing starts that we saw in 2025 was actually the results of decisions taken a year or two prior, right? It takes so much time to build these massive projects, like you mentioned, that what we see is really the results of decisions prior. When you look at 2025 and you look at purpose-built rental construction activity, it's hitting historical highs. A lot of rental construction. This is the result of all the levels of government, concerted efforts from the federal government, provincial, municipal, saying, hey, we need more rental housing. And so there's been a lot of projects, zoning changes, a lot of different programs. I don't know if I said projects, programs that have been put in place to really help support the construction of these rental apartments or rental housing. Now, when you look at what is currently being built, so Toronto is maybe not as historical as the other regions, but is still quite above like historical averages. Is still above historical averages. That being said, when you look forward, we are expecting the construction to kind of trickle down a little bit. When you look at the rental market, that all of that construction that has been going on for a few years has helped relieve the market quite a bit. So if you remember a few years back when you looked at the rental market and people were looking to move out of their parents' house and rent an apartment, vacancy rates were below 1%, close to 0%. Rent increases were skyrocketing in Toronto in 2024. If you looked at the apartments that welcomed a new owner, a new tenant, the rent increase was around 40%. Massive. So it was a very, very tight market. Now, with all of that supply coming in, less demand due to immigration, market conditions have eased and have eased quite a bit. And so when you look at what is currently in construction right now in Canada, in terms of the rental units, we are at levels that we haven't seen practically before. And so all of these new rental units are going to be coming online in 2026, in 2027. So again, good news for tenants, because that means more choice. That means that, property managers are offering a lot more incentives. You easily find those 1 month free, 2 months free. I've also seen we're going to pay for your moving, so come to live with us and we'll not only pay 2 months free rent, but we're also going to pay for your moving. So a lot more incentives. Rent growth has been slowing down and asking rents have been coming down. But that being said, is obviously also impacting decision making for developers. That is making it more financially hard to make the math work. construction costs are extremely high, and there's other challenges as well, like you mentioned, whether it be at the municipal level or not. But if you just look at the mathematic of it, it is going to be increasingly hard. And so knowing that the housing starts of today or of tomorrow are the decisions of today, with that in mind, we expect that rent market in terms of new construction to kind of slow down in the next few years.
So when speaking about that and talking about, okay, we've got challenges in the housing market, we've got challenges, coming up potentially in the multi-purpose rental space. We're talking now about the future of our population growth now in Canada, which we're seeing that decline, like exponentially, to be honest, when you look at it. Do you think the solution on this, will there be adjustments, do you think, in terms of immigration? We'll be able to see more policies change to bring more immigration into Canada, since we are such a country of diverse population because of the immigration that we brought in, which has been incredible to see. And very positive in a lot of aspects for the growth of Canada. Do you see that changing and policies adjusting so that we can bring more immigration in to help with this housing crisis that we're in?
So that's a really interesting question. When we talk about that affordability, those challenges, so maybe you would recall that a few years back, well, last year we updated the numbers, but our estimate was to restore affordability levels, we need to double the pace of construction in Canada. And in order to do that, there are some structural challenges that need to be addressed. So if we only look at these cyclical aspects, like, for example, immigration, for example, developers that are moving, pacing on their construction, but then will come back and build back again. These are cyclical. The housing market is very cyclical. Now, in order to be able to restore affordability, we need to address these structural underlying long-term challenges that are present, notably in the housing construction industry. So when you think about productivity in the housing industry, it has been very stagnant for over a decade. Obviously, it's a problem with other industries as well, but it's very evident in that space. There hasn't been a lot of new innovations or technologies that would help costs come down, that would help accelerate construction. And so those are the types of factors that really need to be addressed in order to accelerate that pace of housing, ensure that we have a more stable supply of housing that is coming into the market, because we talked about a suppressed demand. We estimate that there's quite a lot of people that are waiting to form their household. I think that the conversation should be more about, okay, what do we do to kind of address those bigger challenges that are underneath to help that cycle kind of become a little bit less intense in terms of a roller coaster, right? A little bit more of a smoother ride as we look forward.
Yeah. No, such a great point. Such a great point. Put you on the spot, eh? That's okay.
You got me. Yeah. Well, I think like a few ahas. I think like for me, the arrear story and the mortgage renewal wave was one of them, because I was one of the ones that was worried for that. And so I think seeing that the stress test, the impact of regulation kind of a few years into it, seeing how that has actually benefited a lot of home buyers, a lot of consumers. So that was definitely one of them. That ramp up in rental activity as well was, we were talking about, affordability crisis for such a long time, and people were saying, okay, but what are we actually doing to help support the crisis? And housing takes time. We tend to forget about it. We tend to minimize that, but it takes a lot of time. So to actually see, all of these huge projects coming to life, all of this new supply that is coming online and really helping Canadians a little bit more when we talk about affordability. So that was definitely a good sign, I would say, in the last couple of years, to kind of see seeing that we're advancing and that we're making some progress in terms of affordability. But like I said, I am worried about where the risks that are looming ahead. I am worried that this activity, this momentum that momentum that we've gained, that we might be losing a little bit of traction on that. And the current economic context is not helping, right? I mean,
Yes.
we forecasted, so our forecast was released earlier this year. Already at that point, we were seeing, okay, 2026 is not going to be an easy year economically speaking for Canada. That cloud of uncertainty that was looming over our heads was still very evident at that time. And now, with everything happening in the world right now, and that, geopolitical context that is adding more of those dark clouds over our head, it's definitely not it's definitely affecting businesses, affecting consumers. It could have other spillover effects as well. And so, yeah, I think that's where I'm a little bit more worried in terms of kind of losing that momentum
I
that we
agree.
gained.
And I feel like in our industry, we've said this where we start getting momentum, we start getting this optimism, we start getting nicer weather in Canada and some provinces. It starts opening up the window again of the housing supply and people looking to buy and sell. And then we get hit with a global crisis, and people sit on the sidelines and, wait and see, which rightly so. I understand where people are at, but we've had this for the last few years. So I feel like people are almost is a word, like it's almost like media exhausted, like
Yes.
everything's coming up, and it's hard to keep track even on our side. Like there's some things I just kind of turn a blind eye to some extent, but I don't go down a rabbit hole in it, so that I know when we're talking to clients, but I don't want to get into it. It's like, let's put the oxygen mask on for yourself and what's good for you and your family at this time and what makes financial sense. And I think that's what, if anything, I would say that what's happened over the last 5 or 6 years, and maybe you could speak on this. One thing is I'm going to say is that I think that Canadians, whether or not they wanted to, got a wake-up call on their financial well-being and are more financially educated than ever before. And sometimes it's taken them down a very challenging path, but sometimes challenging will also bring opportunity of being more resilient and also be in a place of affordability based on where your income is. Because you have to do that. It's resetting, right? I think as Canadians, we're resetting from the last 5 years of this up and down hockey stick on values and housing market supply and interest rate cycles. Maybe you could talk a little bit about how you feel on that.
Well, I definitely think that there's, you mentioned that resiliency aspect and kind of that wake up call in terms of, the finances. When I was talking with a lot of people externally around like these longer amortization periods, and people are saying, oh, that's not a good idea. At the end of the day, you're like paying so much more in interest rates. And that is true. That being said, for many, many people, it's like the only option in the short term. And so if that makes sense, financially speaking, in the short term, then that is a good option as well. So looks very different for, we all have very different financial situations, but in generally speaking, like you mentioned, there is that kind of like that wake up call. And for me, I think one of the elements that for first time homebuyers that did enter the market during the pandemic, those that are the more leveraged. So those are the cohorts that have less equity built on their homes.
Exactly.
They have the highest levels of debt. And so when you're looking even across the country, so we talked about mortgage arrears being higher in Toronto, to some extent in Vancouver, but when you look across the country, that cohort of pandemic era first time home buyers, those are the ones that are showing, that are struggling a little bit more. So it is difficult, in a context where cost of living is high. With the whole geopolitical situation right now, there is a risk. We don't know how long this conflict will last. We don't know what the intensity of it will be, and that will, have a different play in terms of what we can see for the Canadian economy. But there is a risk for inflation as well. And so when we talk about that high cost of living for Canadians, it's not something that is looking to go away in the recent next short future window, if you will. Same thing for mortgage interest rates, right? So we're in the middle of that wave. There's still 1 million Canadians that have to renew their mortgage in the coming year. So it's going to be important to kind of look at where, each of us, we stand financially, look at what that's going to mean. But in terms of interest rates coming down in the next year, I think that is unlikely.
Yes. And I think that's going to lead me into one of my final questions to you. Well, Tania, if you were speaking directly to Canadians, homeowners right now that are approaching mortgage renewals over the next 12 to 24 months, what is one of the most important things that you would want them to understand about this current economic environment?
So the most important thing, I think it's being informed. You mentioned, us being more informed than in previous years. I think being informed, being proactive in terms of, we know that the mortgage renewal is coming up, being proactive in talking with your mortgage specialist and looking at the different housing market conditions in your sector as well. There's a lot of elements that are at play. So I think being proactive and being aware as much as you can, that's going to be very important.
For all the listeners, thank you for being a part of the Beyond the Mortgage community. If there's one thing that I've learned over the years, it's never just about your mortgage rate. It's about strategy, timing, and understanding the bigger economic picture. And until next time, stay informed, stay curious, but most of all, make sure that the financial decisions that you're having is beyond the mortgage. It's about putting your oxygen mask on first and taking care of yourself and the family. And until next time, we'll see you then.
Thank you so much, Tracy.